we can go ahead and start. So I will start the timer now. Wharton, whenever you're ready, take it away.
Thank you. Hi, we are Kate and Bonnie, and we're representing Wharton. Our third teammate, Eugene, unfortunately had a conflict and is unable to present today. Next slide, please, Bonnie. So today we will be pitching Clear Channel Outdoor, so CCO's 7.75% senior unsecured notes due 2028, which are currently trading at around $106 with a CCC credit rating. And we've set a target price around $110, which represents a target return of 10% over a 2-year hold period. CCO is one of the largest players globally in the out-of-home advertising market, and we believe presents an opportunity to invest in a leading player in a stable industry that is already seeing post-COVID recovery and is going to see tailwinds from digital. We believe the CCO 2028 notes are an attractive investment opportunity, as we have identified 3 near-term catalysts that we expect to improve the cash available to the business and also improve the creditworthiness of the notes. These are: 1, strong cash flows from the underlying US business, which is already seeing strong post-COVID recovery; 2, cash proceeds from a likely sale of the European assets; and 3, revenue tailwinds from the rise of digital. And we will discuss all of these in depth. Next slide, please, Bonnie. In terms of the company and industry, CCO operates in the out-of-home advertising segment, and this covers billboards, transit displays, and street furniture. We feel this is a stable and attractive industry, as 1, it is one of the fastest growing segments in the advertising space, and 2, in key markets like the US, there are strong regulations like the Road Beautification Act, which limits the number of players in this space. The out-of-home advertising industry saw about a 30% drop in revenue in 2020, as companies were not paying for outdoor advertising during COVID lockdowns. However, this sector is already seeing strong recovery now that lockdowns have ended, and globally is forecast to return back to FY19 levels by 2023. And here we also expect to see tailwinds from digital. CCO is a leading player in this space. It's the 2nd largest player globally, behind JCDecor, and is 3rd in the US. And this is an industry which benefits from scale in its local markets. CCO's business is split between a US segment, which primarily focuses on billboards, which are also higher margin, and an international segment, which primarily consists of street furniture in Europe and is lower margin than the US business.
Great, thanks, Kate. Now, before we talk about our investment thesis, we'd love to give you an overview of the capital structure. So CCO business has the US business, which sits with the CCO Edge, and its international business sits with CCI BV entity. The CCO Edge entity and CCI BV, they do not cross guarantee each other's debt. And the 2028 notes that we recommend sits with the CCO Edge business, which is the US business. And as you can see here in the cap table, net leverage through the US only EBITDA is around 9 times. And here on the left side is an overview of the bond information. The 2028 notes we recommend has $1 billion of outstanding, maturity through 28, CCC ratings, senior unsecured. We believe that Clear Channel Outdoor and its 2028 notes represent a good buy because CCO has historically been a more stable business throughout the cycle, and it should benefit from the recovery in COVID. As you can see here in the right side, Clear Channel Outdoor has actually seen, or the entire outdoor industry is seeing a recovery from COVID. The mobility trends in driving and transit has already recovered and exceeded the pre-COVID level. And in the air travel side, the air travel data, according to TSA, has also recovered to almost 80% of pre-COVID level. As such, we believe that Clear Channel Outdoor should also benefit from this recovery, and we should expect to see a significant improvement in its credit profile. We will expect to see the free cash flow to turn positive for the entire company in 23 and for the US business to 2022. And the leverage should decline for the total company to below 10 times by 2023. I'll pass to Kate.
Thank you, Bonnie. Our second investment thesis focuses on a likely sale of the international business, which we expect to be credit positive for the 2028 notes by reducing required CapEx spend, improving margin, and also generating cash proceeds. The majority of CCO's international business is its European street furniture business, with also some small holdings in LATAM. CCO also previously held a stake in a Chinese business, but this was sold in March 2020. For CCO, the European business is significantly lower margin and also less consistent than the US business, and also requires significant CapEx. While the European business was around 50% of FY19 revenue, it was only 20% of EBITDA, and the EBITDA margin is only a third of what CCO achieves in the US. We also believe there are strong indications that CCO is looking to sell its European business and focus more on the higher margin US market. In particular, the recent change in the worldwide CEO to the former head of the US business. Here, we also think there's a clear strategic buyer in JC Decor, who is dominant in Europe and also has a strong focus on street furniture. Using historic and forecast earnings to create a range and use a conservative multiple range of 6 to 9x, we estimate that a sale could generate between $700 million and $1.3 billion. We also expect the sale to be credit positive for the notes. Selling the European business will reduce CapEx requirements and enable CCO to focus on its higher margin US business. These businesses, due to the different formats, operate quite separately, so we don't think there's any synergies between these businesses. Based on the underlying documents, we expect that CCO will use the sale proceeds to first pay down around $400 million of the European debt at the CCBIV level, and likely also look to pay down other senior US debt to reduce interest expense and actually be able to take advantage of the flex under its loan documents. Particularly, we think the debt incurrence and restricted payments covenants, which both require either under 7x leverage or over 2x interest coverage. Next slide, please, Bonnie. Our third investment thesis is that CCO will be able to capitalize on the revenue tailwinds from digital that we are seeing in the industry, and we think this will further improve free cash flow. Digital out-of-home advertising has seen significant growth, and this growth is only expected to continue. Digital is expected to reach about 2/3 of outdoor advertising expenditure in 2022, and an average and the growth rate in this industry is expected to be above 13% for the next several years. We see CCO as well positioned to win in digital and benefit strongly from these tailwinds. CCO has been actively investing in digital and started its investment earlier than key competitors like Lamar and Outfront. CCO has also developed Radar, which is the industry's first suite of campaign planning and measurement tools, and actually enables CCO to provide feedback on campaigns. And also CCO has been effective in monetizing these digital assets and sees this as a key driver of its future growth. While only 2% of total billboards, digital billboards have been providing 30% revenue. All this together, we see as a strong positive, as billboard digitalization is accretive for free cash flow. It costs an estimated $300,000 to convert a billboard to digital, and there's a payback period of 2.1 years. CCO has currently around 71,000 billboards, and we estimate that CCO can digitize a further 500 billboards over 2022 to 2024, growing from 1,500 now to 2,000, and this will be cash flow positive from FY24 onwards.
Now we would like to walk you through our projections and evaluation. We run two cases on CCO, one base case and a downside case. Here is the base case projection and valuation. So in a base case, we believe that CCO should be able to return to the pre-COVID level in 2022. As mentioned before, the outdoor industry has been stable historically, but COVID created a unique down cycle for the entire outdoor industry. However, as we believe that the worst part of COVID is now behind us, Clear China Outdoor's performance should be able to recover back to 2019 level in 2022. So as you can see here, we modeled revenue, especially in the US side, back to the 2019 level in 2022. Companies should be able to generate consistent free cash flow and liquidity. They have sufficient liquidity runway, which will stay above 500 to 600 million range. And also leverage through the US debt will decline to 8.6 times from currently around 10 times. On the valuation side, we run a DCF and sum of parts comps analysis. And as you can see here, there should be sufficient valuation coverage through the 2028 notes. We also ran a downside case on the company where we modeled a delayed recovery in the business. We assume that the recovery is not going to happen until 2023. Although the company's free cash flow, especially in the international side, is going to be pressured, but they will still be able to generate sufficient like cash flow and to support liquidity. As you can see that liquidity runway, although pressured, should still remain sufficient. In the downside case, although the company will have like thinner valuation coverage, it's still 1.1 times covered through the 2028 notes. Now I'll pass to Kate, who will cover the risk section.
Thank you, Bunny. In terms of risks, we've identified and assessed 3 potential risks to our investment thesis. The first one is a delay in post-COVID recovery impacting cash flows. And we've assessed, as Bonnie mentioned, we've assessed the scenario of a slower recovery in our downside case. And as Bonnie discussed, even in this scenario, CCO will have sufficient liquidity until free cash flow turns positive, and the 2020 notes are covered under this downside valuation. The second risk we assessed is that JC Decor might not buy CCO's European business or may be prevented from doing so, for example, due to antitrust concerns. Here, we have identified other potential buyers who operate in CCO's European markets, such as Stroa and APG SGA. Additionally, JC Decor has previously partnered with PE firms in acquisitions, and if it adopts this strategy, this could also help address any antitrust concerns. The third risk we assessed was the loss of key customer contracts, potentially as a move to digital makes contracts more flexible. Here, we again see CCO as well positioned to retain its position against both existing players and potential new entrants. Against existing players, CCO has long-term contracts with key facility providers of prime advertising locations. For example, New York and New Jersey airports, and also San Diego the transit system. And these are lucrative to customers, and these are lucrative locations to display advertising. CCO also has strong relationships with national advertisers, which are around 40% of its business. And these are relocating advertising spend to out-of-home media. And it's another way that CCO will maintain these contracts. Against new players, there are high barriers to entry, as we previously discussed, due to the regulations. And this makes it difficult for new players to enter the market and challenge CCO in the space.
Now I'm going to cover the relative value. So based on the analysis we mentioned, we believe that 2028 notes represent a good buy. So as you can see here, the 2028 note is currently trading around 200 bips wider than its direct competitor Outfront's same maturity notes. This is considered to be wide compared to a historical gap of 50 bips to 100 bips. We believe that this is caused by a high leverage and a free cash flow burn during the down cycle of COVID. However, as mentioned, we believe that free cash flow is going to turn positive for Clear China Outdoor in 23, and the leverage is going to decline as the company generates free cash flow. So we believe that this gap should tighten up by at least 100 bips. In addition, Kate also mentioned that there will be upside from the sale of international business as well as digitalization. Therefore, we come up with a target price of $109 and a return target of 10%. We believe that 2028 notes is a good buy. And now we're open to questions.
Hey there. Thanks for this. I guess just a question on the cash flow. I guess maybe can you go back to the slide where you had the cash flow? I was trying to understand because you showed on the base case the total unlevered cash flow, and I can't quite tell the difference because the numbers don't necessarily add up. But I guess the general question is how are you getting them to positive cash flow when you have the business getting to pre-COVID levels in 2023, yet prior to COVID, there was no cash flow on a consolidated basis when leverage was considerably lower. So how do you square that? Has the capital intensity changed? What has happened that gives you confidence that cash flow is actually going to be positive? Because historically they didn't have it when they had a much lower leverage profile.
Sure. So what happened historically was that they had the China business, which they actually sold during COVID in 2020. And the China business was actually free cash flow negative. So in 2021, going forward, after they sold China, we actually modeled the free cash flow in US and international business separately. And we believe that free cash flow will start to turn positive as on the US side, they will sort of like recover and continue to improve their revenue growth.
Are these levered or unlevered free cash flow numbers? It says unlevered on the page.
Those are actually like after interest, but before debt repayment.
Okay. I guess I'm happy to continue with a couple. I guess on the M&A side, I'm glad you addressed the risk of JCDecaux not being able to purchase them. I guess have JCDecaux and others being a buyer of the European assets has been a expectation for a very long time with Clear Channel Outdoor. If I recall, I think there were several times that they put the portfolio up for sale. PE buyers looked at it as well, but ultimately did not buy the asset. I guess two questions. One, what's changed? Why this would sell today? And secondly, as you think about the regulatory issues for JCDecaux, are there specific markets where JCDecaux would have bigger issues from a regulatory perspective? And how does that overlap with Clear Channel's markets?
So in terms of M&A, the reason we think this sale is likely is that the indications from CCO that they are looking to focus more on the US business. I think primarily the change in CEO to the head of the US business, the former worldwide CEO is also being moved to focus on strategic acquisitions. So I think there probably be more effort to sell this business, particularly as the margins are different and a slimmed down business will be easier to operate for CCO and help go cash flow positive. In terms of the risks, I think likely probably France would be a market just because JCDecaux is French and it has a very strong presence there. In terms of the antitrust, we know that I think in this industry, regulators are looking at antitrust differently. And one strategy that JCDecaux did in China, they actually acquired the Clear Channel Media, which is where CCO had a 50% stake in combination with PE partners, and they ended up with about a 23% interest. So I think there are strategies at play that they can use to address those concerns, particularly in markets like France, where JCDecaux has a strong footprint. And actually there's some history there. CCO won a contract over JCDecaux for a Paris street furniture contract for the city of Paris. So I think there'll be interest from JCDecaux to get it back in its home territory.
I guess just from a cash flow perspective again, you guys highlighted some of their large, I think, airport contracts and others. If I recall, those are fairly substantial capital intensive projects, especially when they come up for bid. Are there any large contracts that are coming up for rebid that you're aware of that could change your perspective on cash flow and liquidity?
I think in terms of those contracts we've highlighted, so there is a distinction in terms of contracts with facility owners. So the New York and New Jersey, it's the ability to use the space in the airports for advertising, which makes CCO more lucrative to advertising customers because they want to have eyeballs in those areas. These contracts are long-term, so we understand these are not coming up for renewal anytime soon. In terms of contracts with advertisers, so these are typically in the US about 1 to 2 months. In Europe, it's closer to 1 to 2 weeks, which is another feature of the US market, which makes it more attractive. And we think that here, given CCO's focus on digital, the presence it has in these key areas such as airports, we're not aware of any contracts which we think may not be renewed, but it is a 1 to 2 month time frame. So we need to keep an eye on that. But just given its presence and strength in digital, we think it's a very attractive provider to advertisers.
And then lastly for me, just on the relative value where you had the notes versus Outfront. The Outfront leverage being fairly comparable. Is there anything that's unique to that structure, the company, that may cause their spreads to be considerably tighter than Clear Channel's for what doesn't seem to be that material difference in leverage or potential credit risk?
And just wanted to clarify, you mean like given the upfront leverage is also elevated, is there a reason why upfront is trading inside of Clear Channel Outdoor?
Yes, is there anything that would explain that why are investors accepting comparable, what seem to be comparable credit risk, but at materially less spread?
Sure. So I think like first of all, as we can see, the 28 nodes of Clear Channel Outdoor is CCC, and Outfront secure nodes is like single B. So there's one, like this is the one reason why Outdoor is trading side of Clear Channel Outdoor. And also like here, we took a look at the LTM leverage of Outfront. So Outfront was also impacted by the COVID lockdown, the downside. So that's why its leverage is sort of elevated. Going forward, we believe that both Clear Channel Outdoor and Outfront should benefit and deleverage from here. Historically, Clear Channel Outdoor has also been trading, as mentioned, like 50 bits, 100 bits wider than Outfront. It's one thing is because Clear Channel Outdoor has lower margin than Outfront. The average margin for Clear Channel Outdoor is around 20% versus Outfront has over 30% of margin. This is due to the lower margin in the international business at Clear Channel Outdoor. And then also Outfront has a higher EV to EBITDA valuation. This is partially because Outfront is a REIT business versus Clear Channel Outdoor is not. Traditionally, like investor has been giving more credit to Outfront and Lamar on their valuation. Therefore, you have more valuation coverage in Lamar and Outfront notes.
Thank you.
Hi, it's Ricky here. Hopefully you can hear me. One question I had is, have you taken a look at the breakdown in terms of national versus local advertising, and how do you feel about that in terms of the challenges ahead, in terms of Clear Channel's exposures, and particularly in the US, if you think they're going to pivot here, and just kind of how you think about that in terms of framing probably relative value to Lamar and Outfront, which may have a little bit slightly different profile.
So in the US, national advertisers are around 40% of CCO's business. And having a strong presence with national advertisers is definitely in CCO's favor, because these campaigns tend to be bigger, they tend to be longer as well. And having these strong relationships is of benefit to CCO. And so we expect, based on the offering, their strength in digital, they'll be able to keep building on these relationships. And if we see a mix shift further to national advertisers, we also think that'll be in CCO's favor.
And I think we're just about at time here. So thank you so much for the pitch and judges for judging. We will now move you, Team Wharton, into the breakout room. We ask that you stay logged on until the